Thank you. Ladies and gentlemen, before we begin today's session, the next agenda is the opening speech by the Dean of Faculty of Economics and Business, Professor Vincent with Didi Arianto, MBA, PhD. For Professor Vincent, the floor is yours.
Yeah. First of all, we would like to apologize for having trouble with the sound. Yes. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, to all faculty members of Faculty of Economic and Business, Universitas Dian Swantoro, students of both university, from Udinus and Shaheed Beanzir Bhutto University, Pakistan. Honorable guest speaker, Dr. Nawaz Ahmad. Good morning, yeah. There's still morning, yeah, but also good afternoon for those who are in Semarang.
Yeah, it's morning. Good morning.
Yes. We would like to convey our great appreciation for your dedication to share your expertise on investment appraisal based on cash flow, particularly to broaden our students' knowledge, yeah, regarding the literacy of investment appraisal. According to Indonesian Authority of Financial Services, usually we call it as OJK, only 21.84% of Indonesians are well literate to investment and financial products and services. Therefore, this is our challenging task to increase the level of literacy through education for young generation. Last time, there are so many investment manipulation and embezzlements occurred in Indonesia. This is our daunting task to prevent the wrongdoings through education. For students, please do not hesitate to ask Dr. Nawaz as our guest speaker to ask your inquiries, to ask your questions regarding the investment appraisal. And again, thank you very much for Dr. Nawaz Ahmad for your insight and fruitful discussion. And we thank you also for all participant students of both university, Udinus and Shaheed Beanzir Bhutto University, for your presence and for your virtual presence and participation during the discussion today. Wassalamualaikum warahmatullahi wabarakatuh. Thank you. Enjoy your seminar.
Waalaikumsalam. Thank you, Professor Vincent. Ladies and gentlemen, we are about to enter the main session of this event. Please let me introduce our moderator for today, Ibu Ana Kadarningsih. Ibu Ana is lecturer at Universitas Dian Swantoro, and she is the head of international relations of the Faculty of Economics and Business. Her contribution to the faculty has also helped us bring today's webinar to life. To Ibu Ana, the floor is yours.
Okay, thank you, Mr. Haunan. First, I want to say greetings. Good morning, Dr. Nawaz, and all my friends in Pakistan. And then good afternoon for all participants in Indonesia. I would like to read the CV of Dr. Nawaz. By the way, how are you, Dr. Nawaz? Can you hear me?
Yes, sir. Yeah, I'm good, alhamdulillah. Thank you.
We meet the first time in the online webinar, right? So So it is my pleasure to meet you, sir. And then I will read your CV. You have a very amazing CV, Dr.
Yes.
Nawaz. You have, I think, 4 pages, look, and then a 1 pages profile. So I will read your CV. And the first thing is industry experience from September 2014 as principal consultant in FTS Karachi, right? And then January 2021, business consultant, NBDP Smeda Lahore. And then September 2021, consultant in ADB Manila. Wow. And then a consultant 2013 until 2017 at a DGTR Custom Karachi. Yes. And then the university experience, December 2021, associate professor at Shaheed Beanzir Bhutto University, Pakistan. You know, Dr. Nawaz, Prime Minister Beanzir Bhutto is my favorite lady in the world, really, because she's very smart. Yes, I like her really much. And she also beautiful. And then January 2021, it's OD, Business Administration in Karachi. And then adjunct professor 2021 in Jamshoro. And with many university experience, you have a visiting professor, I think 1, 2, 3, 4, 5, 6. I think more than 6 visiting professor, right? Mostly in Karachi. Yes, Dr. Nawaz. And then your subject, your major science is accounting, principal, financial, cost, and managerial.
Okay.
Yes.
Miss Hannah, it's
Yeah.
Miss Hannah, it's long to go. I think it will take a lot of time.
Yes.
So I think let's start
I need
the
your
session.
permission so I can jump. But
yeah.
one thing I must read this one. So Dr. Nawaz has a 167 research publication in national and international, wow, report journal and conference, and 1,810 citation, 22 H index, and 39 index in Google School, right, Dr. Nawaz? Okay.
Yes, I mean
Yes,
it's been increased now. Because
congratulations.
when I shared, it was I think a month earlier.
Yes, you have 167 research. Oh my God, I don't have much like that. Okay, maybe we go to the next agenda. Okay, Dr. Nawaz, you can present about investment appraisal in 35 minutes maximum. So time is yours, Dr. Nawaz,
Okay.
please.
All right. Thank you. So is the screen visible? I've shared the screen.
Yes, yes. We can see clear.
Okay. All right, so today's topic is investment appraisal. All right, because whenever we do any sort of investment, we should know all the financial and all the economic pros and cons. So what is the need of the project appraisal? Why are we supposed to do this? Or what could be the benefits of conducting a project appraisal? You see, to evaluate the economic value of the project. For instance, if there is a certain project, you see, we receive certain cash, certain amount in order to conduct the project. and there are certain future outcomes, that is financial outcomes of the project. So we evaluate that whether the future outcome is more viable if we compare with the initial investment or not. So if it is so, then we go to the project. Otherwise, we keep our hands off the project, because in the later situation, the project may cause financial damages. All right. So we should know the economic value of the project. Secondly, to avoid financial losses. You see, if somebody tells you, okay, this is the project of, let's say, worth 1 million. We will invest 1 million today and we will get future earnings on the basis of today's investment. So we have to evaluate all the future earnings with today's investment. If the economic value of the future earnings is better than or is more than the initial investment, then that particular investment is viable. Otherwise, that investment will cause financial losses. And finally, to make evidence-based decision. You see, there are two things. Now, what happens usually if somebody invests? So majority of the laymen, they do not get evidence-based investment. One of my friends told me to invest in that particular stock, so I invested. I didn't know and I lost. I didn't know exactly. I let's say bought this particular asset, but it does not give me the value what I invested in. One of my friends told me, one of my relatives told me to go for that. You see, if we invest on the basis of some references, somebody told me, one of my friends told me, or one of my relatives told me, it may cause financial damages, because in this particular situation we do not get evidence. And what is the evidence? To prepare formal cash flows, to apply certain financial analysis. On the basis of those analysis results, we should go for the decision, because then the decision will be sound. It will be called evidence-based decision. Okay, ji. So far types of projects are concerned, we have two main types of the projects. One is mutually exclusive and other is mutually not exclusive. Sometimes we may come across more than one project. So then how to decide whether to go for that or to refrain from investment in those particular projects. So the basic things are, in case of mutually exclusive, as it is shown with the help of diagram, that two projects, they are exclusively apart. They have no overlapping. They have nothing mutual in between. They both are independent. So if this is the case, so if one project is favorable, pick up the one which is favorable. And the unfavorable one, we should not go for that. If both are favorable, pick up the one which gives us more economic value, which is better. That one's supposed to be picked up. And if both are unfavorable, so we are not bound to pick up anyone. We will pick none of them. In case of mutually not exclusive, when there is certain overlapping, certain communality are there. So in that particular case, if one project is favorable, so we have to take the net effect. For instance, one is positive 100, other is negative 70. So overall, if we net off, we are getting positive 30. Then we have to go for both the projects if we are intended to invest. Because in case of mutually not, we have to pick up all the projects because they are certain communalities, certain, for instance, if we complete one, then the outcome will be the input of the other project. So that is how they are in a supply chain. So we cannot opt one in case of mutually not exclusive. If both are favorable, pick up both. If none is favorable, so we need not pick, we need not invest in any of the projects. So hope it's clear. Okay. Then types of cash flows. We discussed types of projects, now types of cash flows. There are two types of cash flows: initial outflow and subsequent inflow. So initial outflow is at the timeline 0. Timeline 0 shows today. For instance, if I am buying a solar power, right? So I have to invest. For instance, if I want to buy, let's say 5 kVA, so at least 600,000 I have to invest today. So my investment is cash outflow because I'm paying. So there is cash outflow. 600,000 I spent and I installed a solar system. Now, what will be the future benefit of this project? The electricity saving, the bills we supposed to pay, now we are not supposed to pay, right? So there is the savings, and that is supposed to be our future cash inflows. So we will streamline all the cash inflows, and then we will calculate whether this investment is feasible or not. So generally, the studies which have been done, they depict that if you install a cash solar system, within 3 to 5 years, you will get the payback. And its usual life is 25 years. So rest 21 years, I mean, you will enjoy. You won't pay anything, any bill to the against the electricity. So this is one type of cash flow where there is initial outflow and future inflows. There is another type where initial outflow is there and future inflows are there. For instance, if you invest in some real estate, you bought a shop, you bought a plot, or you bought some apartment. So on lease, not with the cash. If you buy with the cash, then it will be the first type, initial outflow. But you got on lease basis, whereby you're supposed to pay the rentals in the future timings. Monthly, you're supposed to pay, right? And you are getting benefit, all the benefits today. If you buy a vehicle, a commercial vehicle on lease basis, so you got all the vehicle today and you are paying the price in future cash flows, right? And you are getting benefit today. So these are two different types of cash flows. But the first one is very common, very general. Usually all the investments made based on the first type. There is initial outflow and the future inflows. Hope this is clear. Okay, ji. Pick up a scenario. There is an example where I said initial investment is 500,000 with the residual value of 100,000. You know residual value? When the assets is totally used up. And then whatever you can fetch from the market is residual value. All right. We also call it scrap value, residual value, scrap value. And you know, when we compute depreciation, what we do? Cost minus salvage value divided by life. So this is also called salvage value. Residual value, salvage value, and scrap value. when the asset is totally depreciated and the book value got 0, then whatever you can fetch from the market is residual value. And to keep it short, I just kept the life 5 years, and the interest rate or the discount rate is 7% or 0.07. Annual maintenance is 10,000, which increases by 20% after each 2 years. That is 20% for first year. For the third and fourth, 20% further increase, and for the fifth year, 20% further increased. Other expenses are 5,000 per annum. So this is a scenario what we are we will be following to resolve. Bhutto. कहाँ करना है जो देख लो ना. ओके जी. All right. Let's proceed. Okay. In this slide, you can see the timeline 0, 1, 2, 3, 4, 5. 0 refers to today. And since the project life is set to be 5 years, so 1, 2, 3, 4, 5. कैसे पता चलेगा आवाज आ रही है? Miss Anna,
Yes.
hello.
Yes, Dr. Nawaz. Yes.
Okay, all right. Actually, I mean, we connected some other devices as well. So I just want to make sure.
Yeah.
That
We
I am
still can
audible
hear you.
and
Yes.
okay, you are audible
Yeah.
to the entire lecture hall as well. Thank you.
Thank you.
Okay, Ji, let's to see the cash flows at time 0. That is today. We invested 500,000, so this is the negative value. In business and finance, what we do, we put in parentheses. Parentheses, bracket. Bracket shows negative value. And then 200,000 for first and second year, 150 and 150 for the third and fourth year, and for the fifth year, 100,000 is the cash inflows based on the project we invested for 500,000. All right, fine. Then the residual value. The treatment of residual value is because by the end of the project, when the asset is totally depreciated, what it can fetch from the market is residual value. So we will get residual value by the end of fifth year, or that is by the end of the project life, which is year 5. So I added this 100,000 of residual value as well, because it will be a sort of cash inflows when we dispose the asset off by the end of its life. Less maintenance. So 10,000 and 10,000. So it was 20% increased. It becomes 12,000 for 2 years. Then 20% of the 12,000 is loaded, and that is 14,400. So by taking away maintenance, we obtain net cash flows. All right. Then we took away depreciation. Mind it that depreciation is a non-cash expenditure, because depreciation expense we do not pay from our pocket. It is a non-cash expenditure, so we took it away first, and then we subtracted the tax amount, which was at the rate of 20%. So this is, we subtracted depreciation first, then we subtracted tax, then we added back the depreciation amount. So this is called tax shield. What do we call it? Tax shield. And in fact, this theory was presented by Modigliani and Miller. You might have said it in finance, which is also called as model. So Modigliani and Miller suggest that if a firm is highly leveraged, it will get benefit in the taxation. That was the crux of theory. All right. So having that in mind, we subtracted depreciation first, being non-cash. Then we took away tax. If you do not subtract depreciation first, we have to pay more taxes. So the logic behind is, since this was a non-cash expenditure, we took it away, then we took away tax, then we added back depreciation, and we obtain free cash flows. Once we obtain these free cash flows, we supposed to discount it, which is given to us. The rate of discount was given 7%. So simple, by obtaining present value of the future cash, these were the stream shows present value. And when we sum up the present value of the future cash flows with the initial outflow, so we obtained net present value. This is also called NPV approach. If NPV is positive, then project is feasible. If NPV is negative, then project is not feasible. You see, I'm connecting this with the initial slide I discussed with you. What happened? This, to evaluate the economic value of the project. So by computing NPV, or the net present value, we are evaluating the economic value of the project. All right. We can also compute IRR, internal rate of return. What is internal rate of return? It is the rate, the discount rate at which we, if we obtain NPV by utilizing such discount rate, the NPV will be 0. So that particular discount rate is called IRR. So if IRR is greater than the required rate of return, then project is feasible. Our required rate of return was 7%. IRR is 16%. So it means this is far better to invest. This was the decision, right? NPV is positive, project is feasible, discount rate, IRR is greater than discount rate, project is feasible. Now I would like to show you, these calculations in the Excel file. I have Excel. Okay, Ji, is this the Excel is visible?
Not yet, Dr. Nawaz.
Ms. Anna, is the Excel sheet visible?
Not yet. I cannot see in the Excel.
Okay. All right. क्या कर रहा हूँ यार इसको स्क्रीन पॉज क्यों हो गई है, पता है कुछ? चलिए मैं इसको स्टॉप शेयर कर देता हूँ।
We see now, Dr. Nawaz, the Excel.
Is this visible?
Yes, visible.
Okay. If they hard, you can see this. Okay. How to utilize Excel? I mean, it's very easy to follow Excel for the project appraisal because there are cells, columns. We can easily give the address of that particular cell and we can.
Kalau di kelas ibu hadir nggak hadir, saya hitung hadir saja nak. Minggu depan adik-adik presensi 2
I'm
kali.
sorry, Dr. Nawaz.
Jika di kuliah umum ada esensi, silahkan absensi biar dapat
Please,
sertifikat.
co-host, please mute.
Kalau Bu
Yes, Miss Anna, you are saying something.
hadir gak hadir, dihitungnya
I think
hadir, jadi besok
Someone are talking
2 kali
Indonesia,
kuliah.
Dr. Uwed.
Presensinya
Pak Pradana, can you mute the participant?
Hello.
Okay, please proceed, Dr. Nawaz.
May I proceed, Miss Anna?
Yes, you can proceed now. Thank you.
Okay. So you can see initial investment is 500,000.
Yes,
Residual value 100,000. Life is 5 years. Interest rate is 0.07. Tax rate is 20%. Annual maintenance and other expenses. All right. I think these I could not incorporate these other expenses, so leave it up at a moment. Okay, ji, these are cash flows. You can see that initial investment 500,000. I just multiply this cell with -1 so that I could get a negative value. Then these are 200,000, and now 150, 150, and finally 100,000. There is the residual value I just plugged in. Okay. Maintenance. You see cell F1 shows the maintenance amount. So I simply put F1 here, F1 here. And what about this one? It's 20% increased. So F1 multiplied by 1.2. See? So it's 1.2 or 120%. Same here. And now again 20% in the air 5 increases. So I'll just pick this cell, that is F10, and I'll multiply with 1.2 or the same actual maintenance amount multiply by 1.2 square, because 1.2 into 1.2. All right. So that is how we obtain this, the second incremental value. We subtracted, we obtained these net cash flows, then depreciation. We took away depreciation, we obtained this. C13, that is the amount. We have to apply. What we have to apply? Sorry, sir. We have to apply tax rate, which is 20%, right? Here it comes. You can see C13 into B5. At B5, I have tax rate. And then I fix this B5 by putting F4. The row and the column both are fixed. Because if I drag it, so in formula, all the cells, they keep on changing. And if I fix it, so it won't change. So all the values, they will get multiplied with this B5 cell. That is the importance of, you can see every cell is getting multiplied with this. We took it away, then we have to add back depreciation, we obtain free cash flows. All right. Make it more visible. Okay. Then the discounted values. We have 7% discount rate. So %7 is interest rate. So C17 divided by 1 plus C4, not C5. I'll adjust it here. C4. All right. And exponent is yes. So that is how it is obtained. And when we sum them up, we will get NPV. You can see simple is equal to sum SUM bracket open. The negative and the positive cash flows, they are summed up and we obtain this NPV. What about IRR? Again, very simple. If you are using Excel, equal to simple write IRR bracket open. Again, took the all cash flows, outflows and inflows, and press enter, you will get 16%. To be more accurate, you can on decimals, it's 15.892% and rounded off 16%. But being finance and economics students, sorry, you're supposed to give at least 2 decimal places, at least. Otherwise, 4 decimal places are recommended. If you might have noticed that if you want to exchange currency, so currency exchange rates are up to 5 or 4 decimal places. And you know, in money market, what happens? At the 4th decimal place, people make money. So they are important. They are not negligible. Right? So please do not round off the figures. All right. So hope that what we discussed is regarding the project feasibility, types of the projects, types of cash flows, and what is the need of project appraisal. And finally, we did one example as well. We computed NPV and IRR, and we made the decision that project is feasible. So I'm sure it will help you. Yes, Ms. Anna.
Okay, thank you, Dr. Nawaz. You know, I'm very interested with the calculation in Excel because we don't have that. So can we get, yes, can we get the Excel, Dr. Nawaz? Can you share to me? Because this is very good. Okay, we can calculate in Excel. It's very simple and very easy, right? And I can share to my student.
All right.
Okay.
I've already sent you the Excel as well, along with the PPT.
Yeah. Thank you so much, Dr. Nawaz. Okay, we move to Q&A session. I will open maybe a 3. Who will ask to Dr. Nawaz? Maybe 3 person. You can ask directly or you can chat in the chat room. student or lecturer at a business and economic faculty also can ask in this session. Okay, anyone? Maybe I will ask first, Dr. Nawaz. Can I ask? Because my dissertation or my PhD thesis is about investment, and you know, I ever read that dividend policy can improve the investment.
You see, I mean, dividend policy is a bit different aspect, because again, it depends upon what is the basic dividend, and we forecast that what will be the future dividends based on the growth rate, right? The growth might be positive, growth might be negative. So, I mean, the simple formula is, you know, the D naught into 1 plus G power N. It's simple, the exponential formula whereby we can compute. So, again, moreover, it depends upon the board of director meeting of the company, that whether they are announced dividends or they do not announce dividend. And
Yes.
secondly, if they announce dividend, how much dividends they are going to announce. So it's entirely different area, and it's subjective issue depending upon the policy of the company and the board of directors decision.
Okay, Dr.
These are the
yes.
project appraisal so far is concerned. It is based on certain capital investment. For instance, if I'm going to erect a factory, a cement factory, or you know, a steel factory, that what is the initial outflows and what will be the future inflows, and that is how we can connect and we can obtain the economic value, that whether the project is viable or not.
Okay, thank you, Dr. Nawaz. Okay, I open again on the questions session. Please ask about investment. Anyone? Or maybe you can write in the chat room and I will read. Wait. I see. Maybe Mrs. Wikan Istika, you want to ask to Dr. Nawaz? Because I know you from accounting program. I think my students very shy, Dr. Nawaz. I don't know why.
Doesn't matter.
Yes.
Actually, students here. Students are also leaving. You can see.
Really?
And
really, in Pakistan too, they are
students
shy
they
too.
want to get rid of. Yes. You see, I mean, this is a universal psychology for the students.
Yes.
If they get off, they'll be more than happy. If they get rid of as soon as possible, they'll be more than happy. So I think let's conclude it. I mean, thank you very much. It was my pleasure to be with you in today's session, and inshallah we'll conduct more in future. So thank you very much to you, to the dean, and all the staff, supporting staff who were with me and who were with you today, and to the students as well, who in fact who have bonus
yes.
for 1.5 hour.
Yes,
So
but Dr. Nawaz, I'm sorry, I have one questions again. I'm sorry. Okay. You say about Modigliani and Miller theory, right? That leverage will give high leverage will give high return, right? But you know, if we have a high leverage, So it means we will get a higher risk. You know, I'm not a risk taker, so I don't like an investment with high risk. But I know if I not choose the high risk investment, so I cannot get a high return, right? So how can we know that the investment can give a minimum risk and but high risk? How can we know that?
Yes, yes, Ms. Anna, you are right. Actually, you see, since you have allotted me only 30 minutes, initially or 40 minutes, so I just touched upon the basic idea of investment appraisal. Otherwise, it is a lot of things. I mean, the risk factor is very much important. Even the inflation factor is there. We have to adjust inflation as well. We have to, you know, make a lot of factors incorporated. And higher there is, higher the return. This is very much common. So again, the risk assessment is there. Then there are a lot of risk types. Whether there is a systematic risk or whether there is, you know, some fixed sort of risk, whether there are, you know, some market dynamics, they are associated with the risk as well. So then it becomes a very comprehensive thing. You are right. You are right. Many things are supposed to be incorporated. This is only the basics I touched upon.
Okay, Dr. Nawaz. So we can use your Excel calculation to minimize the risk. Yes. Before we start to plug in investment. Yes, Dr. Nawaz.
Yes.
Okay, that's good. Yes. Thank you. Okay, maybe Noah. Okay, I think this session almost finished. Yes, Mr. Haunan. Yes. Okay, we continue. The next session is a take picture, right? The photo section. Okay, I want to ask all participants, please open your camera because we want to take picture. And don't forget to smile. I want you all smile because this is a happy day today. Please open your camera. Dr. Nawaz, once again, Shukriya. Shukriya.
Oh, welcome. Welcome, welcome.
Okay, yang lain. Okay. All participants, please open your camera. I only see a few participants. Okay, Mr. Pradana, are you ready? I will count and you can take a photo, okay? But wait. Still not open. I think only 10% open the camera. But 90% is not open the camera. Please open your camera. It only takes maybe 2 minutes to take camera, to take photo. Okay, we are ready now, Mr. Pradana?
Yes, yes.
Yes. Okay, we are ready now. I will count. 3.
Okay, let's take a shot.
Yes. 3, 2, 1, smile. Okay, once again. Maybe you can give pose like this or what? Not too formal. Okay. 3, 2, 1. Okay, thank you so much. Finish?
Yes, finish.
Okay, thank you. Thank you all participants. Thank you, Dr. Nawaz. It is my pleasure that you join with us now because we need investment appraisal is because this is a very difficult subject. And once again, I say sukriya.
Oh, thank you. Thank you.
Okay, I will return to Mr. Kaunan.
Thank you, Miss Anna. Ladies and gentlemen, the ending of our photo session marks the final agenda of today's webinar series session. On behalf of the Faculty of Economics and Business, we would like to thank our keynote speaker, Dr. Nawaz Ahmad, for his sharing today. And thank you, Ms. Anna Kadaningsih, as our moderator and other parties that make this meeting possible. So we will close this meeting. Thank you very much. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam.
Good
Thank you so
afternoon and good
much.
morning. Have a good day.
Thank you, Dr. Nawaz. Sukriya.
Okay, have a good day.
Thank you.
Hafiz.
Bye-bye.
Assalamualaikum.
Waalaikumsalam warahmatullahi wabarakatuh.